What if I told you there's a single deadline that could quietly hand the IRS 25% of your retirement money and millions of seniors have absolutely no idea it's coming? Even worse, nobody is legally required to remind you before it happens. Not your bank, not the IRS, not even the people helping you file your taxes. Miss this one date and you could lose thousands of dollars for no reason other than not knowing the rules. But here's the surprising part. There is also a completely legal strategy that allows many retirees to satisfy this requirement while paying little to no federal tax under the right circumstances. Today we're breaking down exactly how it works in plain English. Welcome back to the Paranism, where we simplify the financial rules that can protect the money you've spent a lifetime earning. Stay with me until the end, because the final strategy is one that far too many people never hear about until after they already paid more tax than they needed to. Let's begin with the deadline that catches countless retirees off guard every year. It isn't hidden behind some secret government document or buried inside an impossible legal code. In fact, it's publicly available for anyone willing to dig through IRS publications. The problem is that almost nobody does, and even fewer people explain it in language that actually makes sense. For millions of Americans with traditional retirement accounts, December 31st isn't simply another day on the calendar. It represents the final opportunity to complete a required minimum distribution, commonly called an RMD. If that required withdrawal isn't completed before the deadline, the IRS doesn't simply send a reminder asking you to finish it later. Instead, they impose a costly excise tax that can reach 25% of the amount you failed to withdraw, and that's before considering the regular income tax you'll still owe once the money eventually comes out of the account. Think about that for a moment. Imagine your required withdrawal for the year is $20,000. Forgetting to take it doesn't eliminate your tax bill. It simply adds another $5,000 in penalties on top of everything else. You haven't saved money. You volunteered to give the government thousands of dollars that never needed to leave your retirement account in the first place. That's like locking your own wallet, throwing away the key, then blaming the lock for keeping your money. One of the biggest misconceptions surrounding this rule is the belief that it only affects wealthy retirees with enormous investment portfolios. Many people hear terms like IRA regulations or retirement distribution requirements and immediately assume they're discussions meant for millionaires. If their retirement savings are relatively modest, they stop paying attention because they believe the rule doesn't apply to them. Nothing could be further from the truth. Whether your traditional retirement account holds $20,000 or $2 million, the IRS applies the same withdrawal rules. The account balance changes the dollar amount you're required to withdraw, but it doesn't change the existence of the deadline or the percentage of the penalty for ignoring it. A smaller account isn't exempt simply because it contains less money. The law treats every eligible retirement account under the same framework. That's why so many retirees are shocked when they discover these rules years after they first became subject to them. They weren't avoiding the information intentionally. They simply assumed it belonged to someone else's financial situation. Unfortunately, the system itself doesn't do much to correct that misunderstanding. Your bank safely stores your retirement assets, processes transactions, and sends account statements throughout the year. But financial institutions generally aren't permitted to provide individualized tax advice. At most, they may include a short notice encouraging you to consult a tax professional regarding distribution requirements. For many people, that notice gets mixed in with routine paperwork and forgotten almost immediately. Meanwhile, tax preparers usually work with the information clients provide during tax season. Unless you've specifically requested retirement distribution planning or tax strategy guidance, many simply prepare the return based on completed transactions rather than monitoring whether every required withdrawal has actually been completed before the deadline. They're reporting history, not managing your retirement calendar. Even government representatives who answer questions about Social Security or Medicare cannot provide personal tax guidance. Their role is limited, and they'll often tell you to speak with a qualified tax professional instead. When you step back and look at the entire process, it becomes clear why this deadline surprises so many people. Every institution involved handles one piece of your financial life, yet almost nobody is responsible for making sure you personally remember this specific obligation. The result is a retirement system where millions of people are expected to follow an important annual rule without receiving a direct reminder from anyone. That doesn't mean the rule is unfairly hidden. It means there's a huge difference between information being publicly available and someone actually explaining why it matters before it costs you money. Because of that, understanding the basics of required minimum distributions becomes one of the most valuable pieces of retirement knowledge you can have. Here's the concept in simple terms. For decades, traditional retirement accounts allowed your investments to grow without immediate taxation. Contributions often reduced taxable income, and earnings accumulated tax-deferred year after year. Eventually, however, the government expects taxes to be paid. Required minimum distributions are the mechanism designed to make that happen. Once you reach the age specified under current federal law, you're required to withdraw at least a minimum amount every year from eligible traditional retirement accounts. Those withdrawals become taxable income in most situations, and that's exactly how the government begins collecting taxes that were postponed throughout your working years. Most retirees already expect to pay income tax when they start withdrawing money. That's rarely the part that causes problems. The expensive mistake happens when someone doesn't realize that failing to withdraw the required amount triggers an entirely separate penalty. Instead of simply postponing taxes, they accidentally create an additional financial burden that never had to exist. There is one important detail that provides a small measure of relief. If you discover the mistake quickly, correct the missed withdrawal, and properly file IRS Form 5329 within the correction period, the penalty may be reduced from 25% to 10%. While losing 10% is still painful, it's significantly better than paying the full penalty. Acting promptly can literally save thousands of dollars compared to ignoring the problem. Still, the smartest strategy isn't relying on the correction process. The smartest strategy is making sure the mistake never happens at all. For most retirees, the annual deadline remains December 31st. There are very limited exceptions surrounding an individual's very first required minimum distribution. But once that initial grace period has passed, every future year follows the same schedule. The calendar doesn't move because life became busy, paperwork got delayed, or someone simply forgot. The IRS expects the distribution to be completed before the year ends. For retirees born before 1953, that first-year flexibility has already disappeared. The deadline is now fixed, and every passing year follows the exact same pattern. Understanding that single rule already places you ahead of countless people who continue assuming someone else will remind them before it's too late. The IRS isn't your retirement coach. Waiting for them to remind you about a tax deadline is about as effective as expecting a speeding ticket to arrive before you press the gas pedal. Now that you understand why the December 31st deadline matters, the next question is just as important. Does it actually apply to you? The answer isn't determined by how much money you've saved or whether you're already retired. It comes down to one surprisingly simple detail: the year you were born. Recent legislation changed the age at which retirees must begin taking required minimum distributions, creating different groups based on birth year. That change has caused enormous confusion because many people continue relying on outdated information they heard years ago. If you were born in 1950 or earlier, your required minimum distributions already began years ago under the previous rules. You've been operating under annual withdrawal requirements ever since, meaning the December 31st deadline is already a regular part of your retirement calendar. For those born between 1951 and 1959, the starting age shifted to 73. If you've already celebrated your 73rd birthday, you're now required to take annual RMDs as well. However, if you're just reaching that milestone, the rules become a little more complicated because your first withdrawal comes with a special option that sounds helpful on the surface, but can quietly create expensive consequences later. People born in 1960 or after fall under another set of rules that generally delay required minimum distributions until age 75 under current law. That means many individuals in this younger group still have years before these annual deadlines become part of their retirement planning. This is exactly why retirees born before 1953 deserve special attention right now. If your birth year falls in 1952 or earlier, you've already passed the one-time grace period available for your very first required minimum distribution. That means your annual deadline is no longer flexible. Every future RMD must generally be completed before December 31st. Many retirees hear about the first-year extension and immediately assume delaying their withdrawal is always the smarter financial decision. Not necessarily. Let's walk through why. Suppose someone turns 73 during their first RMD year. The IRS allows that initial withdrawal to be postponed until April 1st of the following year. At first glance, that sounds like free extra time, more months with money invested, more breathing room before paying taxes. Many people automatically choose to delay because they believe waiting can only help. But here's what often gets overlooked. That delayed withdrawal still belongs to the previous tax year. Meanwhile, the second required minimum distribution remains due by December 31st of that same calendar year. In other words, postponing the first withdrawal doesn't eliminate it. It simply causes two separate required minimum distributions to land inside one tax year. Instead of reporting one taxable retirement withdrawal, you suddenly report two. That seemingly harmless decision can produce a chain reaction throughout your entire tax situation. The first consequence is straightforward. Higher taxable income can push part of your earnings into a higher federal tax bracket. Imagine a retired couple whose ordinary retirement income comfortably falls inside a lower tax bracket. One required minimum distribution might keep them there. But once a second distribution is stacked on top, total taxable income increases significantly. That additional income may cross into the next tax bracket, causing part of those withdrawals to be taxed at a higher rate. You're not necessarily paying the higher rate on every dollar you earn, but enough of your income may become subject to increased taxation that the difference becomes meaningful. The second consequence catches even more retirees by surprise. Social Security benefits can become more heavily taxed. Many retirees assume Social Security is automatically tax-free. That's one of the most persistent myths in retirement planning. In reality, the IRS uses what's known as provisional income to determine how much of your Social Security benefits become taxable. When two required minimum distributions are reported in the same year, that additional income increases your provisional income calculation.